What if I told you that one man quietly turned a few $1,000s into millions? Not through luck, not through inside information, but through a repeatable system that any disciplined trader can learn? And what if I told you this same man went on to become a U.S. investing champion, posting returns so massive that most Wall Street pros still can't believe the numbers? Today, we're stepping inside the mind of that man, Mark Minervini, and breaking down the strategies behind his legendary book, Trade Like a Stock Market Wizard. But let me warn you, this isn't some fluffy buy and hold and hope advice. This is the real playbook for achieving what Minervini calls superperformance, the kind of explosive growth that turns small accounts into freedom-creating machines. Imagine being able to spot a stock before it takes off, to know exactly when to enter, when to exit, and how to protect your capital with almost surgical precision. Imagine trading without the second guessing, the panic selling, and the emotional roller coaster that destroys most beginners. Minervini argues that this isn't fantasy. This is a skill set, a set of rules, and a mindset, and once you have it, you never look at the market the same way again. In this video, we'll uncover the essential principles that turned Minervini from a failing young trader, drowning in losses, into a market wizard capable of compounding wealth at a pace that defies common sense. You're going to learn why most people lose money in the stock market, and why it has nothing to do with intelligence. You'll learn the difference between chasing cheap stocks and targeting true market leaders that go on to double, triple, even 10x. You'll learn how Minervini uses his SEPA method, specific entry point analysis, to stack probability in his favor and only strike when the odds are overwhelmingly on his side. But the real magic of this book isn't just the strategy, it's the mental game. Minervini teaches you how elite traders think, why they never argue with the market, why they cut losses without hesitation, and why protecting your capital is the #1 priority, even more important than making money. Because if you can stay in the game long enough, the market eventually rewards discipline. So whether you're a beginner trying to avoid costly mistakes, or a seasoned trader hungry for an edge, or simply someone fascinated by the idea of turning financial knowledge into financial independence, this summary is going to give you insights that can change the way you trade forever. Get ready, because we're about to break down the mindset, the rules, and the playbook that helped Mark Minervini achieve the kind of returns most people only dream about. And by the end of this video, you'll understand why trading like a stock market wizard isn't magic, it's mastery. Chapter 1 of Trade Like a Stock Market Wizard serves as Mark Minervini's foundational message. Extraordinary performance in the stock market is achievable, but only through a disciplined, rules-driven approach. Minervini opens by explaining that he did not begin as a naturally gifted trader. In fact, his early years were filled with losses, emotional decisions, and repeated failures. What changed his trajectory wasn't luck, it was the realization that successful trading is a skill, not an innate talent. This chapter establishes the mental framework required to understand the rest of the book. Minervini emphasizes that most traders fail not because the market is too difficult, but because they approach it without a structured methodology. They jump in without preparation, chase tips, rely on gut feelings, or react emotionally to price movements. In contrast, elite traders treat the market with the seriousness of a professional athlete or surgeon. They study, practice, evaluate their mistakes, and follow clearly defined rules. Minervini states that this book is for people who are willing to adopt that level of discipline. A key message in this chapter is the concept of superperformance, a term Minervini uses to describe stocks capable of delivering massive, rapid gains. He explains that most investors think in terms of value, cheapness, or long-term holding. But superperformance stocks share very specific characteristics: strong earnings growth, rising relative strength, leadership within a strong industry group, and proper technical price structures. Minervini also stresses that superperformance is not a result of buying low and hoping the market eventually recognizes value. It's about identifying companies already exhibiting exceptional strength and momentum. Minervini then outlines the cornerstone of his approach, specific entry point analysis SEPA, while the technical details come later. Chapter 1 introduces SEPA as a complete trading system built on timing, risk control, and identifying high-potential stocks before their major advances. He highlights an important idea: even a great stock can generate poor results if purchased at the wrong time. Therefore, execution, knowing exactly when to enter and exit, is just as important as selecting the right stock. Risk management also appears early in this chapter. Minervini stresses that surviving long enough to win is crucial. The market punishes large drawdowns, and most traders do not recover from big losses. He explains that professional-level success requires a strict sell discipline, small losses, and the willingness to exit quickly when a trade isn't working. Protecting capital is not optional, it's the foundation of long-term success. Finally, the chapter sets expectations. Minervini tells readers that the strategies in this book have been proven through real performance, including his victory in the U.S. Investing Championship. But he also warns that adopting these methods requires commitment. There are no shortcuts. The reader must be willing to challenge common beliefs, avoid the comfort of average strategies, and think differently from the crowd. Ultimately, Chapter 1 establishes the mindset needed to absorb the book. Trading is a professional craft. Superperformance is achievable, and success comes from discipline, rules, and continuous learning, not from guessing or gambling. Chapter 2 lays out the core principles a trader must understand before attempting to implement Minervini's SEPA methodology. This chapter is essentially the pre-training section of the book: the mindset, basic assumptions, and structural rules that define how superperformance traders operate. Minervini makes it clear that without these foundational concepts, the more advanced strategies in later chapters won't work. The chapter begins with an important premise: price is the ultimate truth in the market. Most investors become attached to opinions, predictions, or stories. They believe they know what should happen, and they ignore what is happening. Minervini stresses that successful trading requires responding to price behavior instead of trying to outsmart it. Price strength, price direction, and price confirmation matter far more than personal beliefs or media narratives. Next, Minervini explains that traders must accept the market's inherent uncertainty. The goal is not to be right all the time. The goal is to achieve positive expectancy, meaning that winners outweigh losers over a series of trades. Beginners often expect perfection and get discouraged when trades fail. In contrast, professionals expect to be wrong frequently. What separates them is the ability to cut losses early and let winning positions grow. This chapter establishes that loss minimization is not a defensive technique. It is a requirement for long-term performance. Minervini then clarifies a common misconception. Successful traders are not focused on predicting the entire market. Instead, they look for individual stocks that meet very specific criteria. Market timing matters, but the greatest returns come from targeting companies undergoing strong growth, positive catalysts, and superior price action. This leads into another key point: market leaders behave differently from average stocks. Minervini states that most people spend too much time on broad market forecasts and too little time studying the characteristics of winning stocks. Another major theme introduced in Chapter 2 is the importance of preparedness and record keeping. Minervini emphasizes that you must treat trading like a professional business. That means keeping detailed notes, analyzing trades, building watch lists, and reviewing setups regularly. He argues that consistent preparation increases your ability to act decisively. When opportunities appear, many traders fail simply because they are unprepared when the market becomes favorable. Minervini also addresses the emotional side of trading. Fear, greed, hesitation, and overconfidence all sabotage performance. The chapter stresses the need for a rule-based system that reduces emotional interference. When rules guide decisions, traders avoid the fatal cycles of overtrading, revenge trading, or holding losing positions out of hope. The chapter also introduces the idea of focusing on growth metrics, especially earnings and sales acceleration, rather than traditional valuation metrics like P/E ratios. Minervini explains that many of the greatest stock winners looked expensive before they made their biggest moves. Traders who rely too heavily on valuation often miss the strongest opportunities. Finally, Chapter 2 reinforces a central message: your primary job is to identify and align with strength. strengthen fundamentals, strengthen price action, and strengthen leadership. The methods in the book rely on the trader's ability to recognize that strength early and avoid weak, lagging stocks regardless of how cheap they appear. Chapter 3 introduces the core of Mark Minervini's entire trading methodology. Specific Entry Point Analysis SEPA. This system is designed to help traders identify high-probability trading opportunities. By combining fundamentals, technicals, and timing into a unified framework, Minervini emphasizes that selecting the right stock is only half the battle. The real edge comes from knowing when to buy. SEPA is built to pinpoint the exact moment when a stock transitions from a period of consolidation to a phase of rapid price expansion. The chapter begins by explaining that most traders enter too early or too late. Early entries expose them to unnecessary volatility, while late entries reduce reward potential and increase risk. SEPA is engineered around the concept of low-risk entry points, where the trader can define risk clearly, set tight stops, and take advantage of asymmetric reward-to-risk dynamics. Minervini stresses that SEPA is not about predicting future price moves. It is about detecting price structures that statistically precede them. A major part of SEPA involves identifying constructive price patterns, especially basing formations. Minervini highlights that before a stock makes a major advance, it often forms a well-defined base with contracting volatility, improving technical strength, and rising demand. These bases, flat bases, cups, saucers, volatility contractions indicate accumulation by institutional investors. SEPA teaches traders to observe the tightening of price ranges, the drying up of volume, and the formation of pivot points where breakouts can occur. Minervini explains the importance of the volatility contraction pattern VCP, a signature technical behavior where the price consolidates through a series of narrowing contractions. Each pullback becomes smaller as selling pressure decreases. This tightening indicates that supply is being absorbed. A breakout from a VCP typically signals the beginning of a strong trend. SEPA focuses heavily on recognizing these contraction patterns and entering when volume expands above a pivot point. Another essential concept introduced is relative strength RS. SEPA selects stocks that are outperforming the market, not lagging behind it. Minervini reiterates that superperformance stocks show strength before they deliver their largest gains. Therefore, SEPA filters for stocks displaying leadership characteristics, higher highs, strong RS lines, and persistent demand. Risk control is integrated directly into the SEPA entry process. Because entries occur near a well-defined pivot, traders can place protective stops just below the breakout level or the most recent contraction low. This enables small, controlled losses when setups fail. Minervini insists that tight risk management is a non-negotiable part of SEPA. The goal is to maximize upside while keeping downside minimal. The chapter also distinguishes between valid breakouts and pseudo-breakouts. Valid breakouts display strong price movement supported by above-average volume. Weaker low-volume breakouts are often traps. Minervini instructs traders to avoid buying breakouts that lack institutional confirmation. Ultimately, Chapter 3 establishes SEPA as a systematic process that blends fundamental quality, technical structures, and optimal timing. It gives traders a repeatable method for identifying stocks entering powerful growth phases, while keeping risk tightly controlled. The rest of the book expands on each component, but Chapter 3 lays the operational groundwork for executing Minervini's entire strategy. Chapter 4 challenges one of the most persistent beliefs in traditional investing, the idea that buying cheap stocks is the best way to find value. Mark Minervini argues that low price, low P/E ratios, and apparent bargains often mislead investors. Instead, the chapter explains that true value is found in high-quality companies demonstrating strong growth, leadership characteristics, and superior price performance even if their valuations appear expensive on the surface. Minervini begins by highlighting a common mistake. Investors often equate low-priced stocks with opportunity. They assume that because a stock has fallen or appears undervalued based on conventional metrics, it has more room to rise. Minervini firmly states that this approach is statistically weak. The most successful stocks in history, those that delivered superperformance, were rarely cheap. before their major advances. Instead, they were companies showing accelerating earnings, rising sales, expanding margins, and strong demand from institutions. The chapter explains that price is not the starting point. A low price can reflect deeper problems: declining business fundamentals, lack of competitive advantage, weakening demand, or poor industry conditions. Minervini argues that traders must reverse their mindset. High-quality companies with strong fundamentals and strong price action are often undervalued relative to their future potential, even when their absolute valuations look high. A key concept introduced here is perceived value versus real value. Perceived value is often based on static metrics like P/E ratios. Real value comes from a company's ability to grow earnings rapidly and sustain that growth. Minervini demonstrates that companies with high growth rates often trade at premium valuations. For good reason: the market is pricing in their future performance. Traders who avoid these names due to valuation concerns frequently miss the highest performing stocks. Minervini also highlights that focusing on cheapness leads traders into value traps. These stocks might look inexpensive because their fundamentals are deteriorating. A declining P/E ratio is not a sign of hidden opportunity. It is often a sign that the earnings is about to fall even further. Instead of guessing whether a turnaround will occur, Minervini instructs traders to focus on companies already proving themselves through measurable performance. The chapter emphasizes the importance of earnings growth, revenue expansion, and operational excellence. These metrics correlate far more strongly with large price advances than valuation multiples. Minervini reinforces that traders should prioritize companies with consistent quarterly earnings increases, strong annual growth trends, and expanding profit margins. Price action remains a central component of Minervini's philosophy. Chapter 4 reiterates that great fundamentals must be confirmed by strong technical behavior. A stock with strong growth metrics but poor price performance is not a leader. Conversely, a stock showing strong price strength often signals that institutions are accumulating shares, an essential component of superperformance. The chapter concludes by reminding traders that superperformance requires adopting the mindset of successful growth investors, not traditional value investors. The most powerful returns come from aligning with strength, not searching for bargains. Value is not defined by low price. Value is defined by the potential for sustained, superior growth. Chapter 5 focuses on one of the most fundamental principles of Minervini's methodology. Successful trading requires aligning with the prevailing trend. Minervini emphasizes that both beginners and experienced traders often violate this rule by buying stocks in downtrends, attempting to catch bottoms, or fighting the market's natural direction. This chapter explains why trend alignment is essential and how it shapes the probability of success. Minervini begins with a clear statement: the trend is your most important filter. If a stock is trending upward, making higher highs and higher lows, it signals that institutional demand is supporting the move. If a stock is trending downward, the opposite is true, regardless of how attractive the fundamentals may appear. Price is the final arbiter of market opinion, and trend reflects the collective behavior of large, informed participants. He highlights that most large stock market winners begin their major advances only after establishing a clear uptrend. Traders who buy too early, before the trend is confirmed, expose themselves to unnecessary risk. Conversely, traders who insist on waiting for stocks to become cheap often end up buying into weakness instead of strength. Minervini stresses that strength leads to more strength, and stocks making new highs are statistically more likely to continue advancing than reverse. A significant portion of this chapter discusses the idea of trend synchronization. For a trade to have high probability, the stock should be aligned with its industry group trend and, ideally, with the broader market trend. Minervini explains that industry groups tend to move in clusters because institutions typically allocate capital across multiple leaders within the same sector. A strong stock in a weak group is less likely to produce sustained gains, while a leading stock in a strong group benefits from broader momentum. Chapter 5 also emphasizes understanding multiple time frames. Traders must confirm that a stock's short-term trend is supported by its intermediate-term trend. A brief rally inside a long-term downtrend is not strength, it is noise. Minervini instructs traders to confirm trend alignment using weekly charts for context and daily charts for timing. If both time frames point upward, the stock meets trend criteria for SEPA-style entries. Another important concept is avoiding counter-trend behavior, especially the temptation to buy dips in weak stocks. Minervini warns that pullbacks during uptrends can be constructive, but declines during downtrends usually signal further deterioration. The trader's job is to differentiate between normal consolidations and outright weakness. SEPA focuses on buying tight consolidations within established uptrends, not catching falling stocks. The chapter also addresses how trend impacts risk management. By trading with the trend, traders can use tighter stops and maintain cleaner entries because the price structure behaves more predictably. When traders fight the trend, volatility increases, stop placements widen, and risk escalates. Minervini reinforces that trend following does not mean buying blindly. It means confirming the stock's leadership characteristics, relative strength, and technical structure before entering. A stock may be trending up, but if it lacks accelerating fundamentals or proper chart patterns, it does not meet SEPA criteria. Chapter 5 concludes by stating that aligning with the trend is not optional. It is a prerequisite for superperformance. The trader's job is not to anticipate reversals, but to participate in established strength, supported by both price and institutional behavior. Chapter 6 explains the importance of understanding stock categories, industry group behavior, and fundamental catalysts when selecting high-potential trading opportunities. Minervini emphasizes that superperformance stocks rarely move in isolation. Instead, they tend to emerge from strong industries, share similar characteristics, and are propelled by meaningful catalysts that shift institutional demand. The chapter begins with stock categories, which Minervini uses to organize how traders identify opportunities. He distinguishes between several types of stocks such as fast-growing leaders, turnarounds, cyclicals, and stealth stocks, but he makes it clear that the SEPA methodology focuses primarily on leaders and emerging leaders. Leaders are companies showing strong earnings growth, accelerating sales, and dominant competitive positioning. Emerging leaders are younger companies beginning to show these traits. Minervini stresses that traders should avoid laggards, even if they appear cheap or have recognizable brand names. Next, Minervini highlights one of his most important principles: industry groups move in clusters, and the strongest stocks almost always come from the strongest groups. Historical market research shows that 37% to 50% of a winning stock's performance is directly connected to its industry group. This means traders should not merely evaluate individual stocks. They should evaluate the entire group's strength. When an industry is outperforming, leadership stocks within that industry benefit from institutional capital inflows, shared catalysts, and collective momentum. To measure group strength, Minervini recommends monitoring relative strength rankings, sector performance, and the clustering of breakouts. If multiple stocks in the same group are forming constructive bases or hitting new highs, that group becomes a priority focus area. Conversely, traders should avoid isolated strength within weak groups, as these situations rarely produce sustainable advances. Another core component of Chapter 6 is the role of catalysts. Minervini defines catalysts as events or developments that fundamentally change investor perception and drive demand. These catalysts are often tied to strong earnings reports, product launches, regulatory approvals, business model shifts, or operational improvements. Catalysts create the narrative and measurable data that institutions can act upon. Importantly, Minervini states that traders must verify whether a catalyst is producing meaningful results. It is not the announcement that matters, it is the measurable impact reflected in earnings and price action. Minervini also underscores that catalysts often appear before a major price move becomes obvious. A company may report accelerating growth or introduce a new product, but the stock may still sit in a base. Traders who identify and monitor these early catalysts gain a significant advantage. because the breakout often coincides with institutional recognition of the new fundamentals. The chapter goes further by explaining how SEPA integrates categories, group strength, and catalysts into a unified screening process. A potential superperformer typically shows strong category positioning leader or emerging leader, strong industry group performance, a meaningful catalyst driving growth, technical strength and constructive chart patterns. When all these elements align, the probability of a major advance increases substantially. Minervini ends Chapter 6 by reminding traders that focusing on strong groups and catalyst-driven leaders is not optional, it is central to finding stocks with the highest potential for superperformance. The market rewards strength, alignment, and measurable improvement, not speculation or subjective opinions. Chapter 7 establishes the specific fundamental criteria that Minervini considers essential for identifying superperformance stocks. While SEPA is known for its strong emphasis on chart structures and timing, Minervini makes it clear that fundamental strength is the foundation of every high-probability setup. This chapter outlines the financial metrics, growth characteristics, and business attributes that consistently appear in top-performing stocks. Before their major advances, the chapter begins with Minervini's core belief: earnings growth is the single most important driver of long-term stock performance. Historical studies of market winners, companies that achieved massive price increases over short periods, show that almost all of them delivered exceptional earnings growth leading into their advances. Minervini highlights the importance of both quarterly and annual earnings growth, noting that superperformance stocks often produce quarterly earnings increases of 25% to 100% or more, with annual earnings rising at a similar or faster pace. Minervini also stresses acceleration, not just growth. A company showing stable earnings growth is positive, but a company whose growth rate is increasing each quarter is far more likely to attract institutional buying. Earnings acceleration indicates operational momentum, expanding margins, and strong demand for the company's products or services. The chapter then moves to sales growth, which confirms that earnings improvements are supported by real revenue expansion, rather than accounting adjustments or cost cuts. Minervini looks for companies delivering double-digit or strong double-digit sales increases. Earnings growth without sales growth can be a warning sign. Paired together, they form one of the most reliable combinations for identifying future leaders. Another essential concept is profit margins, especially margin expansion. Rising margins signal that a company is improving its operational efficiency and competitive edge. Minervini emphasizes that margin expansion often precedes major advances because it reflects internal strength that the broader market may not yet be pricing fully. Minervini also evaluates return on equity (ROE) as a measure of management efficiency. High ROE, often above 15% to 17%, is a common trait among historical superperformers. It shows a company's ability to reinvest profit effectively and scale operations. While ROE is not an entry signal on its own, it helps filter for companies with superior business models. The chapter explains the importance of shares outstanding and float size. Minervini notes that companies with smaller floats tend to move faster because it takes less institutional buying to move the stock significantly. This does not mean traders should only target small-cap companies. Rather, they should recognize that supply dynamics amplify the impact of demand. Minervini also cautions against overemphasizing traditional valuation metrics like P/E ratios. High-growth companies often look expensive based on backward-looking valuation measures, but their future earnings justify premium pricing. Valuation becomes useful only when it is aligned with growth, not used as a standalone filter. Finally, Chapter 7 reinforces that fundamentals and technicals must confirm each other. Strong fundamentals identify a company with real potential. Technical strength and price structure reveal whether institutions are acting on that potential. Minervini's system depends on the intersection of both. Chapter 8 focuses on a critical aspect of fundamental analysis: the quality of a company's earnings. Minervini explains that high earnings growth alone is not enough. Traders must verify whether those earnings are sustainable, repeatable, and supported by real business strength. This chapter provides a detailed framework for evaluating the reliability of earnings and distinguishing between genuine performance and accounting manipulation. Minervini begins by stating that not all earnings are created equal. Companies can report strong numbers through cost-cutting, one-time events, or accounting adjustments, but these do not indicate true operational momentum. Superperformance stocks typically generate earnings growth driven by consistent revenue expansion, improving margins, and scalable business models. The trader's job is to identify strong earnings with underlying substance, not superficial results. The chapter outlines several key components of high-quality earnings. 1. Revenue-based earnings growth. Minervini emphasizes that the strongest companies grow earnings because revenue is increasing, not because expenses are temporarily reduced. Sustainable earnings growth should correlate directly with top-line expansion. If earnings rise while sales stagnate or decline, the growth is less reliable. 2. Margin expansion. Expanding profit margins indicate improving operational efficiency and strong pricing power. Companies with widening margins often have competitive advantages, better cost structures, or successful product strategies. Margin expansion is one of the clearest signs of real business improvement. 3. Recurring revenue strength. Minervini explains that companies with subscription models, repeat purchases, or durable demand often produce more consistent and predictable earnings. This stability makes them more attractive to institutional investors and more likely to produce long-term stock outperformance. For clean accounting practices, Chapter 8 warns traders about aggressive accounting behaviors that artificially inflate earnings. This includes excessive capitalization of expenses, large one-time gains, or changes in accounting methods. Minervini encourages reviewing financial statements for signs of inconsistencies or sudden shifts in reported metrics. 5. Cash flow verification. Minervini stresses that cash flow should confirm earnings. When earnings rise but operating cash flow does not, it may indicate that the reported earnings are not backed by real cash generation. Strong companies typically show positive and growing cash flows alongside rising net income. A key insight in this chapter is the difference between accelerating versus decelerating earnings quality. Even if earnings appear strong today, a slowdown in growth or a drop in margins can signal that the company's momentum is weakening. Superperformance stocks usually show rising, not flattening earnings trends, leading into their major moves. Minervini also explains how institutional investors evaluate earnings. Institutions look for consistency, transparency, and signs of long-term growth. When earnings quality is high, institutions accumulate shares, which shows up in price strength and constructive technical behavior. This is why SEPA combines earnings quality with chart analysis. Fundamentals provide the fuel, and technicals reveal institutional activity. The chapter concludes by reinforcing the central message: earnings are only valuable when they are real, repeatable, and supported by strong business fundamentals. Traders who focus solely on headline numbers risk being misled. Traders who understand earnings quality can identify genuine leaders early and avoid companies that produce temporary or unreliable results. Chapter 9 focuses on a core principle of Minervini's philosophy. Superperformance comes from buying leading stocks, not laggards. This chapter explains what defines a leader, how to identify one, and why top-performing stocks consistently share measurable characteristics. Long before they deliver their largest advances, Minervini begins by stating that most traders make the mistake of looking for bargain stocks that appear cheap relative to past prices or perceived value. However, historical research shows that the biggest market winners were already performing well before their major moves. Leaders are stocks that demonstrate stronger price performance, stronger fundamentals, and stronger demand compared to the broader market and their peers. A central concept in this chapter is relative strength (RS). Leading stocks outperform the market over specific time periods, and their RS lines trend upward even when the general market is flat or weak. Minervini emphasizes that RS is not an afterthought. It is one of the earliest signs of institutional accumulation. When a stock consistently outperforms, it indicates that large investors are continuously buying, providing a foundation for future price expansion. The chapter also highlights that leadership is quantitative and observable, not subjective. Traders should look for stocks making new 52-week highs, breaking out of constructive bases, or showing accelerating fundamentals. Minervini explains that strong stocks often climb the market's performance rankings before they become widely recognized. By the time the public becomes aware of these leaders, much of the early opportunity has already passed. Minervini then outlines the characteristics shared by historical market leaders: superior earnings and sales growth. Leaders consistently report strong quarterly and annual growth, often with accelerating trends. Industry group leadership. Most leaders belong to the strongest industry groups. A stock that leads a strong group has significantly higher odds of delivering superperformance, efficient business models, and expanding margins. Operational excellence helps leaders maintain sustained growth and support institutional confidence. Strong technical behavior. Leaders form tight consolidations, recover quickly from pullbacks, and show persistent demand. The chapter also warns against buying laggards, even when they appear undervalued or due for a comeback. Laggards often suffer from weak fundamentals, declining industry conditions, or structural problems that limit growth potential. Minervini emphasizes that laggards rarely transition into leaders. Instead, they continue to underperform and offer poor reward-to-risk profiles. Minervini explains the importance of selective focus. Traders should maintain watch lists centered on potential leaders rather than spreading attention. Across dozens of average stocks, a small number of true leaders typically drive a disproportionate share of market gains. So precision is critical. Another critical point is that leadership can change. Traders must remain flexible and adjust as new leaders emerge. Leadership transitions often occur when new products, innovations, or catalysts reshape entire industries. Recognizing these shifts early allows traders to position themselves ahead of major moves. The chapter concludes by reinforcing the principle that the best of the best stocks produce the best results. SEPA is built on identifying these leaders early through measurable fundamentals and technical signals. By consistently choosing leaders and avoiding laggards, traders significantly increase their probability of capturing superperformance moves. Chapter 10 emphasizes the essential role of chart analysis in Minervini's SEPA methodology. While fundamentals determine what to buy, chart patterns and price behavior determine when to buy. Minervini argues that price charts provide an objective record of investor behavior, allowing traders to identify accumulation, distribution, and high-probability entry points with precision. The chapter begins by explaining that charts are not tools for prediction. They are tools for decision-making. Charts help traders understand supply and demand dynamics, detect institutional involvement, and recognize whether a stock is strengthening or weakening. Minervini stresses that charts remove emotional bias by giving traders a factual, real-time representation of market action. A major focus of the chapter is the value of identifying constructive price patterns. Strong stocks often exhibit periods of consolidation, volatility contraction, and base formation before beginning their largest advances. Chart patterns reflect these setups visually. Minervini highlights several common behaviors found in high-potential stocks. Tight price action. Tight trading ranges indicate controlled accumulation and reduced selling pressure. When volatility contracts, it suggests that institutions are absorbing available supply, preparing the stock for a potential breakout. Orderly pullbacks. Healthy stocks correct in a controlled manner, typically with lower volume on declines and higher volume on rebounds. Chaotic pullbacks or wide price swings signal instability and weaken the reliability of a setup. Higher lows and rising support. Upward trending lows indicate strengthening demand. This shows that buyers are consistently stepping in at higher price levels, which is a positive sign of institutional sponsorship. Minervini also reinforces the importance of volume analysis. Volume spikes on up days confirm accumulation, while heavy volume on down days signals distribution. A stock forming a valid base should show declining volume during consolidation and rising volume. As it approaches a breakout level, volume provides context that price alone cannot offer. Another central concept in Chapter 10 is the identification of pivot points, the exact price levels where breakouts occur. These points typically form at the end of a constructive consolidation pattern. According to Minervini, buying at or just above the pivot allows traders to enter with a favorable reward-to-risk profile, while validating that demand is driving the move. Pivot points are not subjective guesses. They are specific levels defined through chart structure and confirmed by price and volume behavior. The chapter also discusses recognizing flawed structures. Minervini warns traders to avoid bases that are too loose, too deep, or showing inconsistent volume patterns. Weak structures often lead to failed breakouts or choppy price action. A disciplined trader must differentiate between a proper base and an unreliable one. Minervini emphasizes that the goal is not to memorize patterns, but to understand the underlying logic of supply and demand. When traders learn to read charts correctly, they gain a substantial advantage because they can interpret institutional activity as it unfolds. Charts reveal whether fundamentals are being validated through real buying pressure, a requirement for SEPA level performance. Chapter 10 concludes by reinforcing that chart analysis is an indispensable component of successful trading. It helps traders time entries precisely, manage risk effectively, and align themselves with stocks poised for major advances. Charts are the bridge between fundamentals and execution. Chapter 11 challenges the widely accepted principle of buy what you know, a phrase popularized by Peter Lynch and commonly repeated in the investing community. Minervini argues that this rule, while well-intentioned, is often misunderstood and misapplied, leading traders to prioritize familiarity over objective data. The chapter explains why relying on personal preference or surface-level familiarity can be a major obstacle to achieving super performance results. Minervini begins by clarifying that many investors interpret buy what you know as buy companies whose products you like. This leads people to select stocks based on brand recognition, personal usage, or anecdotal assumptions instead of measurable fundamentals and technical strength. Minervini stresses that familiarity does not equal opportunity. A company may be popular among consumers, but still be a poor investment due to weak growth metrics, deteriorating margins, or declining price performance. The chapter also highlights that many of the biggest stock market winners over the years were not widely recognized brands at the beginning of their major advances. They were emerging growth companies with strong fundamentals and accelerating demand, often operating in industries unfamiliar to the average consumer. By the time these companies became household names, much of the early explosive return potential had already occurred. Minervini argues that this is a critical insight. Superperformance typically comes from identifying leadership characteristics early, not from waiting until a company becomes widely known. Another key point discussed is the danger of emotional attachment. When investors buy companies they personally like, they are more likely to ignore warning signs, hold through downtrends, or justify poor performance. Emotional bias interferes with objective decision-making, and Minervini reminds traders that the market doesn't reward sentiment. It rewards measurable strength. SEPA requires data-driven selection, not personal preference. Chapter 11 also explains that industries unfamiliar to most people, such as specialized technology, biotech, medical devices, or enterprise software, often produce some of the highest performing stocks. These companies may not have mass market visibility, but they show the core traits Minervini prioritizes: strong earnings and sales growth, rising relative strength, constructive chart structures, and clear catalysts. Traders who limit themselves to industries they already understand reduce their opportunity set and miss high-quality leaders. Minervini emphasizes that the correct interpretation of buy what you know should focus on knowing the company's fundamentals, not knowing the product as a consumer. Traders should understand earnings drivers, margin trends, competitive positioning, and growth catalysts. This type of knowing is rooted in research and analysis, not personal familiarity. The chapter also encourages traders to expand their knowledge base. Instead of staying confined to their comfort zone, markets evolve, new industries emerge, and leadership rotates. Traders who adapt and learn about new sectors stay positioned to capture emerging opportunities. In contrast, those who cling to familiar industries become vulnerable to stagnation and declining performance. Minervini concludes Chapter 11 with this principle. Successful trading is not about buying what you already know, it is about learning what you need to know. By following objective criteria instead of comfort, traders increase their chances of identifying true leaders early and positioning themselves for super performance level results. Chapter 12 marks the beginning of Minervini's two-part discussion on one of the most critical components of successful trading, risk management. In this chapter, Minervini explains how risk operates in the stock market, why most traders misunderstand it, and how professional traders approach risk in a structured, disciplined way. The chapter makes it clear that mastering risk is not optional, it is the central requirement for achieving long-term, super performance level results. Minervini begins by identifying a common misconception. Many traders believe risk is tied to how volatile a stock appears or how dangerous it feels. In reality, Minervini defines risk much more specifically. Risk is the amount of capital you are willing to lose if the trade does not work. Risk is not theoretical, it is quantifiable. If a trader cannot define how much they are risking on a trade, they do not have a valid trading plan. The chapter then explains that most traders fail because they allow small losses to turn into large ones. Human psychology naturally resists taking losses, which leads traders to hold losing positions, rationalize poor decisions, and hope for reversals. Minervini stresses that professional traders operate under the opposite mindset. They assume every trade can fail, they predetermine their maximum loss, and they exit automatically when the market contradicts their thesis. A key principle introduced in Chapter 12 is the idea of asymmetric risk. Successful traders seek situations where the potential upside is significantly greater than the downside. This asymmetry is created not by prediction, but by precise entry timing, proper position sizing, and strict stop placement. SEPA entries are designed to minimize risk by entering near pivot points, where technical structures allow for tight, clearly defined protective stops. Minervini then discusses the concept of uncertainty versus risk. The market is always uncertain, but uncertainty does not automatically equal high risk. A position with a small stop loss and clear technical invalidation can be low risk, even in a volatile environment. Conversely, a position with no exit plan is extremely high risk, even in a seemingly stable market. Professional traders embrace uncertainty, but control risk. Amateurs do the opposite. Another important discussion centers on exposure management, which refers to how much total capital is deployed in the market at any given time. Minervini warns that traders often overexpose themselves during unfriendly market environments or periods of poor personal performance. His approach requires traders to adjust exposure dynamically, increasing it when conditions are favorable and reducing it during choppy or uncertain environments. The chapter also emphasizes that risk compounds. A string of small losses is manageable, but one or two large losses can destroy months or years of progress. This is why Minervini insists on a zero-tolerance policy for large drawdowns. Protecting capital ensures traders remain in the game long enough to capture high-probability opportunities. Minervini concludes Chapter 12 by reiterating that risk management is not a defensive tactic. It is an offensive strategy. By controlling losses, traders enhance their ability to compound capital. Without risk management, even the best stock selection and timing become irrelevant. Chapter 13 expands on the principles introduced in Chapter 12 and provides the practical, operational framework for managing risk within Minervini's SEPA system. While the previous chapter addresses the nature of risk, this chapter explains how to control it in real trading situations using structured rules, systematic exits, and position management techniques. Minervini emphasizes that effective risk control determines long-term survival more than any other skill. The chapter begins with the importance of using predetermined stop losses. Minervini states clearly that stop-loss placement must be established before entering a trade. The goal is to remove emotion from the decision-making process and prevent hesitation. When a trade goes against expectations, stops should be placed at logical technical levels, usually just below the most recent support area, pivot point, or volatility contraction low. These levels represent the point at which the trade's technical validity is compromised. Minervini explains that stop losses are not meant to predict failure. They are tools for limiting damage quickly and consistently. Allowing losses to exceed these predetermined levels is considered a violation of SEPA principles. This discipline prevents catastrophic drawdowns and keeps the portfolio stable during periods of market turbulence. Another major topic in the chapter is position sizing. Minervini introduces the idea that the size of each position should be directly connected to the trader's risk tolerance and the distance to the stop loss. This creates uniformity. Every trade risks a similar percentage of capital, regardless of stock price or volatility. Proper position sizing ensures that no single trade can cause disproportionate harm. Minervini stresses that even confident setups must follow sizing rules to maintain portfolio integrity. The chapter also addresses pyramiding and scaling into positions. Minervini explains that adding to winners can increase exposure efficiently, but only when a stock proves itself with constructive price action after the initial entry. Add-on positions must be placed strategically at secondary pivot points. With the same risk control framework, traders should never average down into losing positions. Averaging down magnifies risk and contradicts the principle of aligning with strength. Next, Minervini discusses portfolio-level risk, emphasizing that controlling overall exposure is just as important as managing individual trades. During favorable market conditions with strong breadth and leadership, traders may increase exposure gradually. However, during volatile, uncertain, or corrective environments, exposure must be reduced. Reducing exposure is a proactive tactic, not a reaction to losses, and part of maintaining stable performance across market cycles. The chapter also introduces the concept of risk-to-reward evaluation. Minervini teaches traders to validate every setup by assessing whether the potential gain justifies the risk. Trades that do not offer favorable asymmetry should be avoided, even if the stock appears attractive in other areas. The goal is to consistently place capital behind the highest probability opportunities. Finally, Minervini emphasizes psychological risk control, explaining that emotional discipline is inseparable from technical discipline. Traders must execute stops without negotiation, maintain consistency in applying rules, and avoid impulsive decisions. Successful risk management is as much about behavior as it is about strategy. Chapter 13 concludes by reinforcing the idea that risk control is the foundation of superperformance. By preventing large losses, applying structured exits, and maintaining controlled exposure, traders create the conditions required for long-term compounding and sustained success. Trade Like a Stock Market Wizard presents Mark Minervini's complete SEPA methodology, a rules-based trading system built around identifying high-potential growth stocks, executing precise entries, and controlling risk with professional discipline. Across the book's 13 chapters, Minervini lays out the fundamental, technical, and psychological principles that consistently appear in America's top-performing stocks. Before their biggest advances, the book begins by establishing a key premise: superperformance is not about prediction or luck. It is the outcome of structured processes, selective stock choosing, and strict risk management. Minervini emphasizes that traders fail mainly because they lack a repeatable system and treat the market emotionally rather than professionally. Core to the SEPA approach is the combination of strong fundamental growth metrics with constructive price action. Minervini shows that historical market winners nearly always exhibited accelerating quarterly earnings, rising annual earnings trends, strong sales growth, and expanding profit margins before breaking out. These traits signal operational momentum and attract institutional demand. On the technical side, SEPA relies heavily on analyzing chart structures, particularly volatility contraction patterns (VCP), tight bases, and orderly pullbacks. These patterns reveal where supply is drying up and where institutions are accumulating shares. Breakouts from these structures, validated by strong volume, mark the low-risk, high-probability entry points SEPA is designed to capture. The book also stresses that industry group strength plays a significant role. Leading stocks typically come from leading groups, benefiting from sector-wide catalysts. stronger flows of institutional capital, and collective momentum. Minervini encourages traders to prioritize industries showing clustered leadership rather than chasing isolated moves. A major part of the book is dedicated to trend alignment. Minervini is explicit. Traders must operate in sync with market direction and avoid fighting downtrends. Leadership stocks demonstrate relative strength even in weaker markets, making them essential indicators of where capital is flowing. The final sections dive deeply into risk management, which Minervini defines as the foundation of sustainable performance. He details how to size positions systematically, how to place and execute protective stops, and how to control overall exposure as market conditions evolve. The focus is not on maximizing wins, but on minimizing losses, preserving capital, and maintaining emotional discipline. Without this structure, even excellent stock selection becomes ineffective. Taken as a whole, the book provides a complete, data-driven blueprint for trading high-growth stocks with consistency. Minervini's message is clear. Success comes from applying a rigorous process that aligns fundamentals, technicals, timing, and risk control into one cohesive system. If you found this breakdown helpful and want more content that translates complex financial strategies into clear, actionable insights, make sure you subscribe, hit the like button, and turn on notifications so you never miss a new upload. Drop a comment below on which book or trading concept you want summarized next. And if you're serious about leveling up your investing knowledge, share this video with someone who's ready to take their financial education to the next level.